How to pay off all your debt fast. Home loan, car loan, personal loan, and credit cards. All at once. Channel introduction. Hey everyone, welcome back to the channel. This is your go-to space for building long-term wealth and living a genuinely healthy, financially free life. Because here is what we believe with everything we have got. Your health is your number one form of wealth, and your financial freedom is what protects everything else. So today, we are going deep on one of the most pressing topics that millions of Americans are dealing with every single day. Debt. Video opening. Alright guys, let me start with something that is going to feel uncomfortably familiar for a lot of you watching right now. Look around at the average American household today. There's a mortgage running. There's probably a car loan, maybe a personal loan from when something unexpected came up, and almost certainly, there's a credit card balance sitting there, quietly growing every single month. If that sounds like your situation, you are absolutely not alone. American household debt is at an all-time high, and the average American is carrying multiple types of debt simultaneously. Student loans, auto loans, mortgages, and credit cards, all stacked on top of each other like a financial Jenga tower. And here's the cruel thing about debt that nobody explains when you sign the papers. The problem is never the debt itself. It is the way most people handle it once they have it. Because if you are just paying minimum balances, keeping everything at the same level, never making a strategic move, you are not paying off debt. You are treading water while the interest meter runs. Today I am sharing 5 proven strategies to eliminate your debt faster than you ever thought possible. Regardless of where you are right now financially, whether you have a big mortgage, a car note, a personal loan, a pile of credit card debt, or all 4 at the same time, this video is going to give you a clear roadmap. And I want you to stay all the way to the end, because the math I am going to show you on the home loan section alone might be the most important 20 minutes of financial education you have had this year. The numbers are genuinely shocking. Let us get into it. Chapter 1. The debt trap nobody warned you about. The minimum payment scam. Let me start by making sure everyone understands exactly how the debt trap works at the most mechanical level, because most people do not actually understand this, and the banks are counting on that. Here is a real example. Let us say you have a $10,000 balance on your credit card. You try to pay it off, but this month was tight. Things came up, and you just do not have $10,000 sitting there. So you call the bank, or you log into your app, and you see that option, minimum payment due. It is $300 this month. That feels manageable, right? And the bank is incredibly warm and friendly about it. They are not going to report you to the credit bureaus. No collection calls. No damage to your credit score. Just pay $300 and you are good to go. But here's what the bank is not telling you out loud. On that remaining $9,700 that you did not pay, they are now going to charge you somewhere between 24 and 36% annual interest. Some cards run even higher, up to 40% in certain situations. Every single month you carry that balance, a new interest charge gets added to the total you owe. Do the math on this. If you are only making minimum payments on a $10,000 credit card balance at a 28% interest rate, you will spend over 20 years paying it off, and you will end up handing the bank roughly $20,000 to $25,000 in total. For $10,000 debt, you pay back 2.5 times what you borrowed, and the bank calls that a service they provided you. This is why the person carrying a credit card balance is one of the most profitable customers a bank has, not their mortgage customers, not their business banking clients. The person rolling over a credit card balance month after month is a reliable, continuous income stream for the bank. The first rule of getting out of debt is this: attack the highest interest rate debt first, always. That is not optional. That is the non-negotiable starting point for any real debt payoff strategy. Chapter 2. Escaping credit card debt. The refinance and consolidation playbook. Now that we understand how brutal credit card interest really is, let us talk about the fastest and smartest way out of it. And the core strategy here might surprise you, because it involves using debt to beat debt. The logic is straightforward. If your credit card is charging you 28 to 36% annual interest, and you can find a loan at 12 to 18% interest, you should absolutely take that lower rate loan. Use it to pay off the card immediately. and then pay off the cheaper loan over time. You have not gotten out of debt yet, but you have dramatically reduced the cost of that debt. That alone saves you thousands of dollars. Here are the practical tools available to Americans right now to do exactly this. The first option is a personal loan from a bank or credit union. If you have decent credit, you can likely get a personal loan at 10 to 18%, sometimes even lower through a credit union. You use that to wipe out the credit card balance, and now you are paying a fixed monthly payment at a fraction of the interest rate. Many credit unions, like Navy Federal or local community credit unions, offer personal loan rates that are significantly better than what online lenders or card issuers charge. The second option is a balance transfer card. If you have good enough credit, many cards offer 0% APR for a promotional period, usually 12 to 21 months, on balance transfers from other cards. You transfer your high-interest balance to this card, and if you aggressively pay it down during the 0% period, you can eliminate the debt without paying a single dollar of additional interest. The trap to watch out for here is the fee on the transfer, usually 3 to 5% of the balance, and the much higher rate that kicks in once the promotional period ends. The third option, if you own a home and have built up equity, is a home equity line of credit or HELOC. A HELOC gives you access to a revolving credit line using your home equity as collateral, often at rates of 7 to 10% in today's market, far lower than credit card rates. You can draw from it to pay off high-interest debt and then pay back the HELOC over time at a manageable rate. The significant risk here is that your house is the collateral, so if something goes wrong, the stakes are much higher. Use this tool carefully, and only if you are confident in your income stability. And here is the mindset shift that has to happen simultaneously with whichever tool you choose. You have to stop generating new credit card debt while you are paying off the old debt. That means auditing every single recurring charge on your cards, streaming services you do not use anymore, app subscriptions you forgot about, gym memberships you have not visited in 4 months, delivery service memberships you are paying for out of habit. All of it. Cancel what you do not genuinely use, and redirect every dollar you free up toward the payoff. The fastest way to lose the credit card debt battle is to pay down the balance with one hand and keep adding new charges with the other. That is a treadmill, not a strategy. Chapter 3. The home mortgage math that will blow your mind, and how to beat it. Alright, this is the chapter one want you to pay very close attention to, because the numbers I am about to walk you through are genuinely eye-opening, and understanding this could save you tens of thousands of dollars over the life of your mortgage. Let us set up a realistic American scenario. You take out a $400,000 home loan at 7% interest on a 30-year term. This is close to a very common situation for homebuyers in major markets right now. Your monthly payment comes out to roughly $2,661 per month. Over 30 years, here is what that actually costs. $2,661 per month, times 12 months, times 30 years. You will pay approximately $958,000 in total on a $400,000 loan, meaning the interest alone costs you around $558,000. You borrow $400,000 and you pay back nearly $1 million. That is not a typo. And here is the part that makes this even more startling. When you make your very first mortgage payment, do you know what happens to that $2,661? Roughly 90% of it, about $2,333, goes directly to interest. Only about $328 reduces your actual principal balance. You made a $2,661 payment and your loan balance went down by $328. This pattern, where the vast majority of your early payments go toward interest rather than principal, continues for the first decade and a half of your loan. It is called front-loading, and it is one of the primary mechanisms through which mortgage interest costs become so enormous over 30 years. Now here is the good news, and this is where the real strategy lives. There are 4 specific moves you can make that dramatically cut down your total payoff time and your total interest paid. Strategy 1. Pay one extra full payment per year. This is the simplest, most accessible strategy for most people. Once a year, make a 13th mortgage payment. Your bank will apply this entire extra payment directly to your principal because it is above and beyond your regular scheduled payment. Over time, reducing your principal faster means every subsequent month's interest charge is calculated on a smaller balance. Here is what this actually does for a 30-year mortgage. If you consistently make one extra full payment per year for the life of a 30-year loan, you will pay off that loan in approximately 24 years instead of 30. You have cut 6 full years off your mortgage with just one extra payment per year, and the interest savings are massive. Strategy 2. Increase your EMI payment by 10% each year. This one requires a bit more discipline and assumes your income grows over time, which for most people following a career trajectory it will. In year 1, your payment is $2,661. In year 2, you voluntarily increase it by 10% to about $2,927. In year 3, you increase again by 10%, and so on. The compounding effect of this approach is dramatic. If you increase your payment by 10% every single year on a 30-year mortgage, that loan can be fully paid off in approximately 11 years. That is right, 30-year loan gone in 11 years through disciplined payment increases that track alongside your income growth. Strategy 3. Combine both. This is where it gets really exciting. If you simultaneously make annual 10% payment increases and make one extra full payment per year, you can pay off a 30-year mortgage in somewhere between 10 and 11 years. The math is extraordinary. You have nearly tripled your available home equity years ahead of schedule, saved hundreds of thousands in interest, and freed up your largest monthly expense in your early 40s rather than your late 50s. Strategy 4. Direct any windfall income straight to principal. Every tax refund, every work bonus, every side hustle check, every raise you get above and beyond your normal increase, every time your income gets a temporary boost, make an extra principal payment. It does not have to be a full payment. Even $500 or $1,000 extra applied directly to principal creates a compounding benefit that ripples through every subsequent month of the loan. The key thing to understand about all of these strategies is that extra payments, whether they are $200 above your regular payment or $2,000 above it, go entirely to principal. They do not get split between interest and principal the way your regular payment does. Every extra dollar goes directly to shrinking the balance the interest is calculated on. That is the mechanical reason these strategies work so powerfully. Chapter 4. The Car Loan Trap. What nobody tells you before you sign. Let me tell you something that happened to me, or at least something very close to what millions of Americans experience every year. Fresh out of college, new job, first real paycheck, and the first thing I wanted to do was get a car. Not because I desperately needed one, because I wanted to feel successful. I wanted to have something to show for it. Does that sound familiar? If you are in your 20s or early 30s, or if you are raising kids who are approaching that stage of life, you know exactly what I am talking about. Here is how the car loan trap typically plays out in America. Let us say you have just landed your first job at $55,000 a year. You are bringing home maybe $3,800 a month after taxes. You go to a dealership, you fall in love with something that is way beyond what your income supports, and a salesperson and a finance manager work together to show you that the payment is only $650 a month. That sounds manageable. $3,800 minus $650 is still $3,150 for everything else. No problem, right? Wrong. Because here is what nobody walks you through in that finance office. The payment is $650, but the car also requires full coverage insurance, which on a newer vehicle runs $150 to $250 per month. It needs regular maintenance, oil changes, tire rotations, and the occasional unplanned repair. Call it another $100 to $150 per month on average, plus fuel, which at today's prices for a larger vehicle is easily $200 to $300 per month. Add registration, tolls, parking, and any other car-related expense, and that $650 payment is actually costing you $1,200 to $1,500 per month all in. Now you are looking at $3,800 income and $1,200 to $1,500 in car-related costs. Add rent, groceries, utilities, phone, and basics, and you have nothing left. You are working a full-time job and saving exactly $0 every month. That is a deeply demoralizing situation, and it is incredibly common. And here is the financial reality that makes it even worse. A car is a depreciating asset. From the moment you drive it off the lot, it loses value. By the time you have made enough payments to actually own it outright, it is worth a fraction of what you paid. Unlike a home, which in most cases appreciates in value over time, a car guarantees you will end up with less asset value than you put in. So how do you handle a car loan intelligently? 3 rules. First, keep the term short. Car loans can run as long as 7 years, but the longer the term, the more interest you pay and the longer you remain underwater on the vehicle. Stick to 3 or 4 years maximum. Your payment will be higher, but you will own the vehicle faster and pay dramatically less in total interest. Second, buy within your actual budget, not your aspirational budget. If your income genuinely supports a Honda Civic, get a Honda Civic. Get it in a color you like and maintain it well. Do not finance a vehicle whose all-in monthly cost exceeds 15 to 20% of your take-home pay. Third, apply any extra income directly to the loan principal. Tax returns, work bonuses, side income. Anything above your regular expenses goes to the car loan. Every extra payment reduces the principal and shortens the time you are paying interest. Chapter 5. The Personal Loan Trap and How to Refinance Your Way Out. The personal loan trap is where I see the most young Americans getting into serious financial trouble right now. And the reason it is so dangerous is that it almost always starts with something that seems completely reasonable in the moment. Someone needs a new phone because their current one stopped working. Someone wants to take a big trip to celebrate a milestone. Someone needs to float expenses for a couple of months during a rough patch. Someone wants to upgrade their apartment setup before a partner moves in. These are not outrageous desires. They are normal human wants. The problem is when the way you fund them creates a financial crisis that lasts for years. Here is the math on a typical personal loan trap. Let us say someone takes a $5,000 personal loan through an online lender or a personal loan app at 30 to 40% interest. That is not uncommon with fintech lenders targeting people who need money quickly and do not qualify for traditional bank rates. On $5,000 at 35% interest over 3 years, the monthly payment is around $230, and you end up paying back approximately $8,300 in total. You borrowed $5,000 and paid $3,300 in interest for a phone that depreciated to a fraction of its value. Now here's the way out if you're already in this situation. The first move is refinancing. If you took a high-rate personal loan through an app or an online lender, apply for a personal loan at a traditional bank or credit union and use it to pay off the expensive loan. If you have a reasonable credit score, you can often get a personal loan from a credit union at 10 to 15%, far better than the 30 to 40% you may be paying on an app-based loan. The process of replacing a high-rate loan with a low-rate loan is called refinancing, and it can save you thousands over the remaining life of the loan. The second move, if you have equity and other assets, is to collateralize. If you own a home and have equity, a home equity loan or HELOC can give you access to much lower rates than any unsecured personal loan. If you have a whole life insurance policy with cash value, you can often borrow against it at a very low rate. If you have assets, using them as collateral almost always gets you a better interest rate than an unsecured personal loan. The third move is the behavioral one, and it is the most important long-term fix. Stop borrowing to fund non-essential wants. If you need a phone, buy a mid-range phone for $300 cash instead of financing a flagship device for $1,200 on a high-interest loan. If you want to travel, save for it over 6 months instead of putting it on a loan or a credit card. The short-term sacrifice of waiting and saving is dramatically cheaper than the long-term pain of high-interest debt. There's a reason that the happiest, least financially stressed people in any income bracket tend to be the ones who live within their means. Not because they do not have desires or ambitions, but because they understand that financial peace now creates the freedom to pursue bigger things later. The person who patiently saves for the trip is the same person who, 3 years later, has built enough wealth to not need to save in advance for the next one. Summary: everything we covered today comes down to one overarching principle. Debt is not inherently a problem. Handling debt without a strategy is. Credit card debt is the most dangerous because it carries the highest interest rates, sometimes 24 to 40% or higher. And the minimum payment trap keeps millions of Americans circling the drain for decades without making real progress. The escape route is refinancing into a lower-rate vehicle, such as a personal loan or balance transfer card, and simultaneously cutting off the behaviors that generated the credit card balance in the first place. Mortgage debt, while seemingly inevitable for homeowners, can be beaten by combining annual payment increases, one extra payment per year, and directing all windfall income to principal. Strategies that can compress a 30-year loan into 10 to 11 years and save hundreds of thousands in total interest. Car loans become traps when people buy beyond their actual income, choose long loan terms, and fail to account for the full all-in cost of vehicle ownership. Personal loans become dangerous when sourced from high-rate apps and lenders, but can be escaped through refinancing into lower-rate bank products. The universal truth, connecting all 5 of these debt categories, is this: interest is the enemy of wealth, and every extra dollar you can direct toward principal is a dollar that stops working for the bank and starts working for you. End credits and sign off. All right, everyone, that is a wrap on today's video, and I genuinely hope this one gave you something concrete and actionable that you can take into your own financial situation, whether you are just starting to deal with debt or whether you have been carrying multiple loans for years and have not known exactly where to begin. Here is what I want you to do right now. Grab a piece of paper or open the Notes app on your phone and write down every debt you currently have. List each one with the balance, the interest rate, and the monthly payment. Then rank them from highest interest rate to lowest. That list is your battle plan. Start attacking the top item and work your way down. Drop a comment below and tell me what your biggest debt challenge is right now. Is it credit cards, your mortgage, a car loan? Let me know, and let me know what strategy from today you are going to try first. I read every single comment, and I love hearing where you all are on the journey. If this video gave you value, please hit that like button right now. It helps this channel reach more people who genuinely need this information. And if you are not subscribed yet, click subscribe and hit the notification bell so you never miss a new video. Share this one with someone you know who is struggling with debt. A friend, a sibling, a co-worker, anyone who could use a clear, practical roadmap. It could genuinely change their financial trajectory. Remember, your health is your first wealth. Your financial intelligence is your foundation, and a debt-free life is absolutely within reach if you are strategic and consistent. I will see you in the next one. Thank you so much for watching.